Liza sits down at her desk at 8:47 on a Tuesday morning. She's 28 years old, been working at this regional bank for 6 years, and she's seen thousands of loan applications cross her screen. By now, most of them blur together. Same forms, same numbers, same nervous couple sitting across from her desk, hoping she'll say yes. But this morning, there are 2 applications sitting side by side on her monitor, and these 2 are about to teach you everything the banking industry has spent decades not telling you. The first application belongs to Nico and Hazel. Nico is 36, works in IT, makes $47,000 a year. Hazel is 34, works in marketing, makes $40,000. Combined income, $87,000. They have 2 kids, they've been renting for 8 years, and they've saved $12,000 for a down payment. They walk into the bank holding hands. Hazel's got a folder of pay stubs pressed against her chest like she's carrying something fragile. They're nervous. They should be. The second application belongs to Tom and Susan. Tom is 38, works in the same IT field as Nico, makes $46,000. Susan is 35, also in marketing, makes $41,000. Combined income, $87,000. Identical. Same neighborhood, same school district, same everything from the outside. They walk into the bank 5 minutes later. Tom's got a leather portfolio under his arm. Susan's calm. They look like people who already know the answer. One of these couples walks out with a pre-approval letter. The other walks out with a polite rejection and a pamphlet about credit counseling. Here's what I need you to understand before we go any further. The income was the same. The jobs were the same. The neighborhood was the same. What was different were 6 factors that the bank will never explain to you in plain English, because if they did, you'd walk in ready. And banks don't make money on people who walk in ready. My name is Thomas. I've spent 40 years watching banks decide who gets to borrow money and who gets handed a pamphlet. I've sat on both sides of that desk. And today, I'm going to walk you through all 6 factors exactly as the bank sees them, so the next time you walk into that lobby, you're the one holding the leather portfolio. If this is your first time here, hit subscribe. I release videos like this every week breaking down the money rules that nobody taught you. Let's start with the factor that eliminates more applications than any other. Here's what most people think debt-to-income ratio means. They think I make $87,000. My rent is $1,400. I've got a $350 car payment. That's about 24% of my income going to debt. I'm fine. That's not how the bank calculates it. When a bank looks at your DTI, they don't look at what you're paying now. They look at what you would be paying after the loan. They take your future mortgage payment principal, interest, taxes, insurance, the whole thing, add it to every other debt payment you have, and divide that number by your gross monthly income before taxes. Let me say that again, because this is the single biggest reason people get denied and they never even see it coming. The bank is calculating a fictional version of your life, a version where you already have the loan, and if that fictional version of you is spending more than 43% of your pre-tax income on debt payments, you're flagged. Doesn't matter if you've never missed a rent payment in your life. Doesn't matter if you've got perfect credit. The computer spits out a number above 43%, and your application hits a wall. Here's the math for Nico and Hazel. Combined gross monthly income, $7,250. Their current debts, $350 car payment, $200 in credit card minimums. That's $550. On paper, they look fine. But the median home price in the United States right now, according to the National Association of Realtors April 2026 data, is $417,800. Let's assume they're looking at something more modest, say $280,000. With a 3.5% down payment through an FHA loan, at today's mortgage rates hovering around 6.5%, their monthly payment, including taxes and insurance, lands around $2,300. Now add that $2,300 to their existing $550. That's $2,850 a month in debt payments, divided by $7,250 in gross monthly income. That's 39.3%, under 43%, technically approvable. But here's the kicker. That 43% number, that's the legal ceiling for a qualified mortgage. Most banks set their internal threshold lower 36% for the best rates, 41% absolute max for anything with decent terms. At 39.3%, Nico and Hazel are in what the industry calls the gray zone. They're not auto-denied, but they're not getting the rate they see advertised. The computer flags them as elevated risk, and the rate they're offered is suddenly half a point higher than what Tom and Susan are looking at. Because Tom and Susan, their DTI is 28%. Same income, same mortgage amount on paper. But Susan's car is paid off. Tom paid off his student loans 3 years ago. Their only monthly debt obligation outside the future mortgage is a $120 minimum on a credit card they pay in full every month. Their fictional future self is spending $2,420 on $7,250. That's 33%. Clean. The computer sees 33% and lights up green. Same bank, same income, same Tuesday morning. One couple is getting the prime rate, the other is getting we'll see what we can do. The DTI gap between these two couples isn't about how much they earn, it's about what came into the bank with them. And that brings me to factor 2. Here's a scenario that plays out in banks across America every single day. Someone walks in with a 720 credit score. They've never missed a payment in their life. They pay every bill on time, they walk out denied, and they have no idea why. Here's what's happening behind the screen. Your credit score is not one number, it's 5 factors, and the second most important one right after payment history is something called credit utilization. It's the percentage of your available credit that you're currently using. The rule of thumb most people hear is stay under 30%. Here's the thing, that rule of thumb is wrong, not a little wrong, completely wrong. People who get the best mortgage rates have utilization under 10%, not 30%, 10. According to Experian's most recent data, the average American credit utilization rate in 2026 is hovering around 28%. That's the average. That means half the country is walking into banks with utilization above the threshold that triggers higher rates. Let me show you how this plays out with our two couples. Nico and Hazel have 3 credit cards between them. Total credit limit, $18,000. Current balance, $8,200. That's 45.5% utilization. They pay more than the minimum every month, sure. They've never been late. But every time Eliza pulls their credit report, the utilization number jumps off the screen in red. Tom and Susan also have 3 credit cards. Total credit limit, $35,000. Current balance, $1,400. They use their cards for gas and groceries and pay them off every 2 weeks. Their utilization, 4%. The computer sees 4% and barely blinks. Here's what most people don't understand. Credit utilization has no memory. If you have 45% utilization in January and you pay it down to 5% in February, your score in March will reflect the 5% like the 45% never happened. The problem is timing. When you submit a mortgage application, the bank pulls your credit report that day. Whatever your utilization is on that specific Tuesday morning at 9:14 a.m., that's what they see. And if you ran up your cards over Christmas and haven't paid them down yet, you just handed the bank a reason to charge you more. The difference between 45% utilization and 4% utilization can mean half a percentage point on a 30-year mortgage. On a $280,000 loan, half a point is roughly $28,000 over the life of the loan. $28,000 because you swiped your credit card in December and hadn't paid it off by application day. Read that again. Here's the third factor, and this is the one that catches people who thought they were being smart. Nico has a steady job, 6 years in IT, same company, his W-2s are clean, his pay stubs are consistent. On paper, he's the model applicant, but Nico has something on his application that Tom doesn't. 3 years ago, Nico was unemployed for 7 months. He got laid off during a company restructuring. He collected unemployment. He found a new job. He's been there ever since. In Nico's mind, that gap is ancient history. He's been stable for 3 years now. The bank sees it differently. When a bank underwrites a mortgage, they don't just look at whether you're employed today. They look at your employment continuity. Fannie Mae's underwriting guidelines require a 2-year employment history, and they look for gaps. Any gap longer than 6 months gets flagged. The underwriter has to document it, explain it, justify it. And I got laid off, and it took a while to find something isn't a justification they love seeing on a mortgage application when the median home price is $417,800. Tom, meanwhile, has been at the same company for 11 years. No gaps, no unemployment claims. His employment history reads like a straight green line. The 2-year rule gets even more punishing if you're self-employed. Let me bring in another couple to show you what I mean. Justin and Kimberly. Justin is 34, works as a freelance IT consultant. Kimberly is 33, does contract marketing work. Combined income, $92,000. They make more than Nico and Hazel and Tom and Susan. On paper, they're the strongest applicants of the bunch. That's it. When Justin walks into the bank, he brings 2 years of tax returns, a profit and loss statement, and a letter from his CPA. The bank looks at his 1099 income and doesn't see $72,000 a year. They see variable income that fluctuates seasonally, with some months at $9,000 and others at $3,500. They average it over 24 months. Then they apply a stability discount. Justin's $72,000 in self-employment income gets calculated as roughly $62,000 in effective underwriting income because the bank builds in a cushion for the months when the work dries up. That's an instant $10,000 haircut to his borrowing power before any other factor even enters the equation. The self-employed pay a silent tax on every loan application, and nobody tells them until they're sitting in the chair. Now let's talk about down payments, not how much, where it came from. Nico and Hazel have saved $12,000. They're proud of that $12,000. It took them 3 years. They've got it sitting in a savings account, every deposit traceable, every dollar earned. But 6 weeks before they submit their application, Hazel's parents gift them $5,000. For the house, they say. Hazel deposits the check. It sits in their account. They think, great, now we have $17,000. The bank sees that $5,000 deposit and flags it immediately. In mortgage underwriting, there's a concept called seasoned money. Money that's been in your account for at least 60 days, preferably 90, is considered seasoned. It's your money. You earned it. The bank trusts it. Money that showed up 42 days ago from someone else's checking account, that's called a large deposit from an unverified source. And the bank treats it like it doesn't exist until you can prove otherwise. Here's what happens. Eliza pulls Nico and Hazel's bank statements. She sees the $5,000 deposit. She asks for a gift letter. She asks for Hazel's parents' bank statement showing the source of the funds. She asks for documentation proving it's a gift and not a loan. Because if it's a loan, if Hazel's parents expect to be paid back, that $5,000 is not a down payment. It's more debt that needs to be factored into their DTI. Meanwhile, Tom and Susan have $45,000 in their down payment account. Every dollar has been sitting there for more than 18 months. No large deposits, no gift letters, no parental bank statements required. Their money is, in underwriting terms, fully seasoned. The bank looks at it, nods, and moves on. The National Association of Realtors 2025 profile of home buyers and sellers found that the median down payment for first-time buyers was 10% the highest since 1989. For repeat buyers, it was 23%. The bar keeps rising. And if the money you're using to clear that bar can't be verified, it might as well not exist. This is the factor that nobody outside the industry talks about because it sounds like a conspiracy theory. It's not. It's just math you can't see. Everyone knows about FICO. Most people have heard of VantageScore. What almost nobody knows is that most major banks have their own internal scoring model that runs parallel to your FICO score, and it can override everything. Let me explain how this works. When Eliza pulls Nico and Hazel's application, she sees their FICO score, 692 and 705. Respectable, above the 620 conventional threshold. Should be fine. But behind the scenes, the bank's proprietary algorithm is running a completely separate calculation. It's pulling data points that FICO doesn't weigh as heavily. Things like, how long have you banked with us? What's your average daily balance? Have you ever overdrawn? Do you have a savings account or just checking? Have you ever had a late payment on a loan with this bank, even if it didn't hit your credit report? The internal bank score is the financial equivalent of a permanent record, and you can't see it. You can't dispute it. You can't even request a copy. Because it's proprietary, the bank considers it a trade secret. According to the CFPB's most recent HMDA data analysis, denial rates for applicants with FICO scores between 680 and 719, right where Nico and Hazel sit, vary by as much as 15 percentage points between different lenders. Same FICO, same income, same DTI, 15 points of variance. That gap isn't explainable by public data. That's the internal bank score at work. Tom and Susan, their FICO scores are 742 and 758. But more importantly, they've banked at this institution for 14 years. They have checking, savings, and a small investment account. Their average daily balance is $14,000. They've never overdrawn. The internal score lights up green before Eliza even finishes reading their application. The internal bank score is factor 5, and it leads directly to factor 6, the one that can override everything I've just told you. Let me introduce you to Ezra and Lily. Ezra is 68. Lily is 67. They've been retired for 4 years. Their income is entirely from Social Security, a pension, and investment withdrawals. On paper, their income looks lower than Nico and Hazel's, roughly $72,000 a year from all sources combined. But when Ezra and Lily walk into the bank, they don't even fill out a standard application. They sit down with a relationship manager they've known for 18 years. They have coffee. They talk about their grandchildren. Then they say they're thinking about downsizing from their 4-bedroom to a 2-bedroom condo near the coast, and they'd like to know what they qualify for. The relationship manager pulls up their file. Ezra and Lily have been customers of this bank for 31 years. In that time, they've had 3 mortgages all paid off early. They've had 2 auto loans both paid on time, every time. Their checking account has never dipped below $10,000. Their savings account has a recurring automatic deposit from their investment portfolio every month. The bank doesn't see 2 retired people with low income. The bank sees 31 years of perfect behavior. That's worth more to the underwriting algorithm than a W-2 from someone who walked in the door last Tuesday. Ezra and Lily's application gets flagged for manual override relationship discount. Their interest rate gets shaved by a 1/4 point. Their PMI requirement gets waived. The closing costs get reduced by $1,200 because they qualify for a loyalty credit. Now, you might be thinking, Thomas, that's unfair. I haven't been banking anywhere for 31 years. I'm not 68 years old. What am I supposed to do about the relationship factor? Here's the thing. You don't need 31 years. You need to start today. The relationship factor works on a spectrum. A customer who's been at the same credit union for 3 years with direct deposit, a small savings account, and no overdrafts already has an edge over someone who walks in cold with a 720 FICO and no history. 5 years gets you noticed. 10 years gets you the rate discount. The bank wants to lend to people they know, not because they're nice. Because their data shows that customers with established relationships default at significantly lower rates than walk-in applicants with identical credit scores. The CFPB has documented this pattern across multiple lenders and multiple product types. It's not personal, it's not unfair, it's actuarial. So let's rewind to that Tuesday morning. Eliza has both applications in front of her. Nico and Hazel, $87,000 combined income, 39.3% DTI, 45.5% credit utilization, a 7-month employment gap, $5,000 in unseasoned gift money, FICO scores of 692 and 705, no prior relationship with the bank, internal score, yellow borderline. Tom and Susan, $87,000 combined income, 33% DTI, 4% credit utilization, 11 years of continuous employment, $45,000 in fully seasoned savings, FICO scores of 742 and 758, 14-year banking relationship. Sure, internal score, green preferred. Same income, same bank, same Tuesday morning. One couple walks out with a pre-approval letter at 6.25%. The other walks out with a pamphlet. Here's what I want you to take away from this. None of these 6 factors are secrets in the sense that they're hidden. They're secrets in the sense that nobody volunteers them. The bank won't sit you down and say, by the way, if you'd paid down your credit cards 3 months ago, your rate would be half a point lower. They won't say, that $5,000 your parents gave you, it's going to be a paperwork nightmare unless you wait 60 days. They won't say, if you open a savings account with us today and set up direct deposit, your internal score will look different in 18 months. They won't say any of that because the confusion works in their favor. But now you know. Before you submit your next loan application, run your own 6-factor audit. Calculate your DTI the way the bank does with the future mortgage included. Pull your credit report and look at your utilization, not your score, your utilization. Count the months since your last employment gap. Trace every large deposit in your bank statements back 90 days. If you don't have a relationship with a bank or credit union, start one tomorrow. Even if it's just a checking account with a $500 balance. Because when you walk into that lobby on a Tuesday morning, I want you to be the one holding the leather portfolio. I'm not a financial advisor. This is just me running the numbers out loud. If this video helped you see something you didn't know before, hit like. It tells the algorithm to show this to someone else who might need it. And if you've got a question about your own situation, or if one of these 6 factors hit you harder than you expected, drop it in the comments. I read them.